Good afternoon. Welcome to today's ACE webinar on the Affordable Care Act and providing subsidized student health insurance plan coverage to graduate students. My name is Stephen Bloom. I am the Director of Government Relations here at the American Council on Education, and I will be your moderator today. Just before we sort of get started in earnest, some technical issues to make sure you understand. You'll see in front of you a slide that provides where you can find technical support if for some reason you're having trouble. You see a telephone number there. You can hear this audio. You can hear the audio for the webinar by joining the audio broadcast or by teleconference. Hopefully you're hearing it already. And if you're not hearing it and you're going to be planning to do that by teleconference, you join it by dialing that telephone number 877-668-4490, and the access code is there on the screen, 629-210-582. All of your lines will be muted, whether you're on you're accessing it through a telephone or on the web. Questions and answers, you can ask them during the course of the webinar just by typing them in into the Q&A panel on the lower right side of your screen and just submit to all panelists. We'll do our best to get to as many questions as possible, and this webinar is being recorded and will be available on ACE's website hopefully about a week after the conclusion of this event. So now that we've got the sort of technical issues out of the way, so basically, for a number of years, as many of you know, many research universities have offered student health insurance plan coverage at little or no cost to graduate students as part of their graduate school financial aid package. Schools have provided this subsidized coverage to graduate students because of their status as students enrolled in an academic program. Sometimes these subsidies are provided regardless of the activity of the graduate student on campus, and sometimes they are offered depending upon services a graduate student may provide to the institution, such as teaching or research services. And we want to continue, as I'm sure you all do, want to continue to provide these subsidized coverage because it enhances access to graduate education by reducing its costs, and it helps ensure that graduate students, and often their partners and dependents, that they have affordable quality health insurance coverage. Since the enactment of the Affordable Care Act, the Department of Treasury and the Internal Revenue Service have issued regulations and guidance under the ACA that raise potential concerns about institutions providing this subsidized student health coverage. Today, we have two experts from Ernst & Young to help us unpack this issue, provide you with some guidance, and to answer your questions or concerns. First, we have Helen Morrison, who's a principal in the firm's National Tax Practice Department and a former Treasury official where she did work on implementation of the Affordable Care Act for the Treasury Department. And we have Heather Mead, who I've worked with for many years at Washington Council Ernst & Young, who advises policymakers, trade associations like ACE, including ACE, and others on a broad range of health and tax-exempt issues as a senior manager at Ernst & Young's Washington Council practice. So I will get out of the way and turn it over to the real experts, and we'll start with Heather Mead. Thank you.
Thank you very much, Stephen. This is Heather Mead, and I'm going to start by walking everyone through the agenda about what we hope to cover today. We have a very wide audience of folks on the phone, so not people that have spent a lot of time having to walk through the treatment of student health plans. So we're going to start with an overview of some of the background ACA issues that have led us to the issue at the heart of today's webinar. We'll then go through the ACA treatment of student health plans specifically, the new ACA guidance that are affecting the subsidization of student health insurance, the transition relief that was provided by the IRS, including what it does and, more importantly, what it does not do. And then we want to walk through with you key questions and compliance alternatives, some of the alternatives that your fellow institutions have been looking at, and we'll walk through some of the pros and cons of those proposals and then we'll end with some of the legislative and regulatory solutions that are being explored here in D.C. So with that, we're going to turn to the overview of the ACA and student health plans. So we're hearing a lot, we're 6 years out from the passage of the ACA, and we are still answering some very basic questions about the ACA and how it applies to students. The ACA continues to raise long-standing questions about whether a student is just a student or whether a student who is working on campus may also be an employee of the institution, and if so, when. This has a number of significant implications for institutions looking to implement their Affordable Care Act strategy because it raises questions about how do the individual mandate and the employer mandates apply to students and the health plans that are offered by an institution. It raises questions about how the ACA has treated student health plans, and we'll walk through what the ACA did say and, more importantly, what the ACA did not say about student health plans. And the answers to these questions also have implications about can your students who have been offered a SHIP plan or a student health plan go to the exchanges and receive a tax credit, or does the coverage that you're offering them prohibit them from doing that? And finally, the question that we're going to focus on today is, can universities continue to subsidize their graduate student health plans in the way that they have done so for many years? And this new guidance has called into question their ability to do so, and certainly will require many institutions to make changes to what they're doing now. At the heart of this issue are sort of the questions about the basic coverage rules that are in the ACA. So many of you will have looked at these issues for your faculty health plans. And the basic rule about how the ACA requires employers to treat their employees is it will require employers to pay an excise tax if they have a full-time employee who is within a certain income band, 100 to 400% of the federal poverty level, go to the exchange and receive one of these tax credits. And if they have an employee that does that and the institution has failed to either offer them coverage or they have failed to offer them coverage that meets these new standards around affordability or minimum value, either of those situations are going to trigger tax penalties for the institution. It's important to note here that the requirements only apply to full-time employees and their dependents. And so the definition of who an employee is becomes very important in the ACA. It's important to note that the ACA actually did not change the definition of who is an employee. And in fact, the law was silent on the standard of who is an employee. What this means for the ACA is that we fall back to the common law rules on who is an employee, and we'll walk through those rules and the implications that they have for students. Under the ACA, for the employer mandate, the ACA has defined a full-time employee specifically as a common law employee who is an employee that is working on average 30 hours or more per week. The ACA did have, when they did the regulations on this, the IRS did address students, but only in a very limited capacity. And the carve-out that they provided only applied to students who are working in a work-study capacity, and it was very specific that it has to be work-study. The thing that is interesting about this is that it did not say that these individuals are not employees. What they did say, however, was that institutions will not have to count work-study student hours for determining who is a full-time employee. So we don't have a lot of guidance from the IRS about when an employee is or is not, when a student is or is not an employee. Helen, I'm going to turn it over to you to talk a little bit about the guidance around when a student is an employee.
That's a setup for me.
It is a bad setup in a very gray area.
Okay, so let's launch in. I'm going to go back and reiterate a comment that Heather made earlier, that the Affordable Care Act does not define who is an employee. what it did was it shines a spotlight on the definition of an employee and when an individual, and this applies for all businesses, not just institutions of higher education, struggle with whether a worker is an independent contractor or actually an employee. It's a particularly challenging question for colleges and universities because in an academic setting, you know, again, Heather's comment is a valid one. Is the student just a student? If the student is actually providing services, or is that student also treated as an employee? So what do we have here? We have it's sort of a mess, you know, a circle of mess, because not only is the test for when a student is treated as an employee complicated under the IRS rules, there's also different tests that are applied by other agencies that may be regulating colleges and universities, such as under the Fair Labor Relations Act, the NLRB has one definition, the Department of Labor, and applying the wage and hour rules for the Fair Labor Standards Act has a different definition, and then that brings us to the IRS. And the IRS, for purposes of employment tax, do not treat students that satisfy certain requirements as an employee. However, for other purposes under the Internal Revenue Code, they will apply the common law test. And so you may ask, well, why are there these two different tests that are applied by the IRS? And to a very great extent, it's because when you go back and you look at the statutory language in the FICA provisions for determining whether there's an employment relationship for employment tax purposes, there's an exception for students. And as Heather mentioned earlier, for other purposes in applying the ACA, we don't have that. So consequently, the IRS and the other agencies who regulate the Affordable Care Act have fallen back on the common law test. So why don't we turn to, you know, the next slide that really provides you all, and you all on the phone know this as well or as better than anyone else around, that there are different standards that are being applied by the Department of Labor, as I mentioned, under the Fair Labor Standards Act. The National Labor Relations Board, we know, issued the Brown decision where they concluded that graduate students really are students, not to be treated as employees. That's a decision that I am aware is being challenged right now in the Columbia University and New Schools matter. And then, as I mentioned, we also have the IRS, and we're going to focus to a great extent here because the IRS has taken the lead on how students are treated for purposes of the Affordable Care Act. But the rules, I'll just leave this slide by saying that, unfortunately, the statutory exception that applies for FICA tax purposes, employment tax purposes, only applies for FICA tax purposes, and consequently the IRS has said that they cannot rely on those rules or that exception for other purposes as they relate to the Affordable Care Act. So what is the common law test? Well, I'm not going to go, this is not a session where we're going to spend a lot of time talking about what the facts and circumstances test is to determine who is a common law employee. Again, it's fairly complicated. There are multiple factors that the IRS would look to determine whether, in this case, a student is actually treated as an employee. But there is a bottom line rule, and that bottom line rule, and is the rule that the IRS will look to, is first of all, whether the institution, the college or university, actually controls the relationship, and do they direct and control the working conditions. So in a circumstance where you have a graduate student who, for instance, is providing research services or providing teaching services or other services to the institution, the question will be, is that student, in their capacity as providing services to the institution, are they acting in an employment capacity? I know that you all, both Heather, you and Stephen, have spent some time talking with some of the government agencies, including the IRS, and I think they've been fairly clear that in many, many circumstances, maybe most circumstances, where students are providing those services, if they are under the direction and control of the university, that the IRS's view is that they would be treated as a common law employee. Now, we should emphasize that even though the student who is providing services may be treated as an employee, they will not necessarily be treated as a full-time employee. They may not have hours that, are on average 30 hours or more per week. So their services would not cause the institution to be concerned about the employer mandate excise tax, but you're not out of the woods, because if they're still treated as a student, we have the guidance that we're going to be talking about that also has excise tax implications, just a different excise tax that we'll spend some time talking about.
So let's talk about what the ACA actually did say about student health plans. The ACA did specifically address student health plans. They included a section, but part of the problem with this section is that the language was a little bit vague. And so we have very different interpretations of this language, one interpretation coming from regulators and one coming from institutions of higher education. So the section says that nothing in the ACA is to be construed to prohibit an institution of higher education from offering a student health insurance plan. The problem comes with the next line, which is that to the extent that this requirement is permitted under federal, state, or local law, the agencies, and it's not just IRS, it's also the Department of Labor and HHS, have interpreted this regulation to mean, or this language in the ACA to mean, that they can construct regulations that health institutions offer coverage, but that doesn't necessarily mean that that coverage is accepted from any of the ACA requirements beyond that. So that coverage needs to comply with the market reforms, it needs to comply with the mandate rules, and there isn't any particular special treatment that institutions of higher education are entitled to under Section 1560C. I know, working with ACE, that we spend a lot of time talking about the unique structures of student health insurance and the importance of it, and so there is some question about what Congress intended when they inserted that language, but we certainly have a pretty good understanding of what regulators are thinking about it now. In fact, Helen, I know you had a very recent conversation about this language just last week with some of the members over at DOL and the IRS. Do you mind sharing a little bit of that with us?
Heather and I had a conversation before this that this language in some ways I think is almost a Rorschach test that institutions, I think appropriately would look at it and say, look, this is clearly, statutory language that reinforces the importance of student health plans, and consequently they should be provided special treatment. In the conversation that Heather mentioned that was had recently, it was clear that at least at the staff level of the Department of Labor and IRS, they look to the second part of the clause here that says as otherwise permitted under federal law, and it is not clear to them that this language would permit them to regulate student health plans in a manner that would provide student health plans with special treatment. So, it's a favorable provision for, institutions that offer coverage to their students, but unfortunately, at least I think in the eyes of the, of the regulators, it does not provide them with the authority to establish special treatment for those plans.
We saw a little bit of this when HHS issued their final regulations around student health coverage. And when HHS issued their regulations, what they really focused on was the impact on the student in particular. And what they decided to do was it was very unclear what the treatment of student health coverage was before the ACA. And that had largely worked until the ACA refined and put a focus on the distinction between what is called individual market coverage and group coverage. And in order to ensure that students were able to meet the minimum essential coverage rules, those are the rules that help a student demonstrate that they have met their individual mandate requirements, the HHS came out and said that they are going to treat student health coverage as a type of individual market coverage. So this is not group-sponsored coverage like what employees are offered. It will be an individual policy that follows the student themselves that is unconnected to their employer. It was this decision that is creating the situation that we have today with graduate student coverage. So we can look back to this decision to define it as individual market coverage, and we can sort of see when we move into the discussion of the implications for graduate students, how we got there. When they issued that final rule, they also had a section on self-funded student health plans. Self-funded student health plans are really in a gray area. They were in a gray area before, and they continue to be in a very gray area of sort of benefits law. What HHS said was that they are unable to regulate student health plans based on their authority. Student health plans, self-insured student health plans are not considered individual market coverage, but they're also not necessarily group market coverage unless the individuals to whom the coverage is being offered are being treated as employees. So if the students in the self-funded plan are not being treated as employees, it may not be a group health plan. There are some state laws that have very specific rules for self-funded plans, but in the absence of those, these self-funded plans continue to be in a very gray area. What HHS did say is that they were going to create a special path for students that were enrolled in self-funded health plans to be able to demonstrate that they met their individual mandate requirements. In order to do this, the university itself has to apply to HHS to receive a special approval or waiver to demonstrate that they meet the minimum essential coverage rules, which are substantially similar to those requirements that are also being met by insured student health plans. So, Helen, I think we have here, I think it's clear there are a lot of gray areas between self-funded plans, between individual plans. And I want to give you an opportunity here to explain this very confusing area. And I know you and I talked beforehand about how this is an area where we see a lot of confusion, not just in the higher ed area, but also in employers across the board, that this specific guidance that we're going to discuss now around HRAs and employee payment plans has really caused consternation across the employer world generally. Is that your understanding?
I would say that is a very fair assessment. I'm not certain if it's any comfort to those on the phone that they are in good company with businesses across the board. Small businesses in particular oftentimes will, in fact, reimburse the coverage for their individual employees that are purchasing coverage on the individual market. And it has raised a number of issues. So maybe if we move to the next slide, I'm going to take a stab at trying to explain a rule that, frankly, took the IRS 3 notices and several FAQs to explain to taxpayers, to not just to you, universities and colleges, but also to all businesses that do, in fact, offer health reimbursement arrangements or other type of employer payment plans, which basically means that the employer is paying for or reimbursing the coverage provided on the individual market. It's somewhat unprecedented that, that there were as many notices that were issued, and I think that the reason for that is because it is fairly complicated. So, as I said, let me take a stab at it. So, and try to simplify this and explain something that appears to be a bit illogical to put some of the policy reasons behind why we have the guidance that we have. So at the starting point, let me just describe a scenario. You have a business that is reimbursing or paying the individual's healthcare coverage. And in this circumstance, that coverage is actually being purchased on the individual market. So the first question out of the box for most businesses, it may or may not be the first business that colleges and universities are asking for some reasons we'll get into in a moment, but the first question that most businesses, including the institutions on the phone, would be, how is that reimbursement taxed to the individual? Well, if the reimbursement is being, or if the individual who is receiving the benefit of that payment or reimbursement is an employee, the tax rules have remained the same. That is treated as a reimbursement by an employer-sponsored plan, and there are special tax rules. I mean, those of you on the phone who are employed by your colleges and universities who receive health care coverage, you probably are aware, and if you aren't, I will explain to you that from a tax standpoint, that tax benefit is tax-free to you. You do not pay tax on the cost of the coverage or when you receive benefits under the coverage. That's by virtue of a special tax rule. I vowed not to use in the Internal Revenue Code sections here, but that's under Section 105 and 106 of the Internal Revenue Code. I know, I couldn't help myself, but so the tax rules remained the same. And there's a IRS guidance that dates back to the 1960s that says even if an employer is reimbursing individual coverage that's purchased on the individual market, that reimbursement is treated as pre-tax, not subject to tax, because it is employer-sponsored coverage. So that raises a couple questions for you. Number one is back to the question, is the student treated as an employee or is the student not treated as an employee? And I noticed we have one of the questions that we have here, if you have a fellow or a student who is not providing services to the university and did receive this subsidized coverage, that subsidy in all likelihood would be treated as a taxable benefit. Now there may be some other stipends or other grants that are not taxable. Those rules get somewhat complicated. However, if they are not in an employment capacity and if they're not providing services, there's no employment relationship, then the starting point would be that the subsidy is actually taxable. So if the individual is, in this case the student, if the student is providing services and is treated as an employee, subsidy is pre-tax, but then it raises the question, okay, you just told us that reimbursement arrangement is employer-sponsored coverage. That means that the employer-sponsored coverage has to satisfy the Affordable Care Act provisions. And what the IRS and Treasury have said in guidance is that if the reimbursement is being used to purchase coverage on the individual market, that reimbursement cannot be integrated with the coverage, and consequently, there's some details around this that I won't go into, but just trust us that the conclusion of the guidance is that the reimbursement does not satisfy the Affordable Care Act provisions. The only time the guidance says that the coverage the reimbursement or the payment of the coverage would actually satisfy the Affordable Care Act requirement is if that payment is integrated, used to purchase coverage of a group health plan, an employer-sponsored health plan. So what does this mean to employers? Well, this is the other excise tax we mentioned. If you have a plan, in this case, an employer-sponsored plan that is the payment of coverage that is being used to purchase coverage on the individual market, and here I will just pause to say student health coverage, as Heather mentioned, at least insured student health coverage, is by definition individual coverage. That means that that plan under the IRS and Treasury guidance, and that, by the way, we keep saying IRS and Treasury because they took the lead, but the Department of Labor has also signed on to this guidance. And their conclusion is that that type of arrangement does not satisfy the Affordable Care Act provisions, which could result in an excise tax imposed on the employer, in this case, the institution that is providing the subsidy. That excise tax is $100 per day by affected participant. There's an open question of who the affected participant what that means. Is it just those individuals who are receiving the coverage, or does it mean other student employees who are not entitled to the subsidy if any of those, if you have individuals who fall into that category? nevertheless, it's a significant excise tax and one that you know, is to be avoided, which leads us to some good news. I do believe, well, actually, I think we were going to do a slide here that talks about what the implications are for colleges and universities. One comment that I will mention on this is that no one college or university is alike. I'm sure you have seen this yourselves, that it, from our experience in representing institutions and also in conversations we've had in preparation for this webinar, it's clear that some universities will subsidize through a federal grant or a stipend. Others just provide that subsidy directly. Some will provide the subsidy to graduate students or fellows across the board, whether they're providing services or not. Other institutions will only provide the subsidy if services are being provided. And then you also have some institutions that have treated the subsidy as a taxable benefit, whereas other institutions treat it as not being a taxable benefit. So the one, I think, theme here is that all institutions will need to consider what the relationship is, how they are providing that subsidy, and what they're going to do going forward to try and come into compliance. But now we're going to lead to the good news to talk about the transition relief that was provided by the agencies, because I think they were aware. I mean, I think they do. I would like to say in my conversations they have sympathy for colleges and universities who are providing good and valuable coverage. It's just a question of how to permit that coverage in a manner that is consistent with the statutory rules.
Right. So I think the Treasury Department understood that there were large numbers of colleges and universities that were subsidizing their student health insurance plans for graduate students. And under the guidance that Helen just described, institutions that are subsidizing, in many circumstances, their student health insurance plan that is individual coverage would be at risk of triggering the excise tax that Helen described. The reason that happens is because it violates the market rules that were created by the Affordable Care Act. Because they heard that there were so many institutions that were doing this and that the complexity of the ways that universities were subsidizing this coverage for students, they realized that they weren't going to be able to come up with, that universities weren't going to be able to come up with a quick fix to bring their plans into compliance. And so the IRS, along with DOL and HHS, issued some transition relief. This is Notice 2016-17. And I think there were a couple of things that are important to realize about this notice. What the notice does is it provides transition relief for institutions for the upcoming academic year, so year 2016 through 2017. And it provides relief for institutions that have previously been subsidizing the student health coverage for their graduate students or other students who are working on campus who've been provided with subsidies in this fashion. What it does not do is provide relief from these rules. What it does is it gives institutions a year to figure out their compliance plan for how they are going to move forward with bringing their plans into compliance with IRS guidance. And it is expected that they will use this time to understand the rules and to make those changes. You know, Helen, I've talked to a couple of institutions over the past couple of months since the transition relief was issued who thought that maybe this was the first in a series of notices that we would get that would help us understand how we can comply with this rule, or perhaps the first in a series that will provide some relief for institutions. And I know you raised that question recently to DOL and IRS, and what kind of answer did you get back?
Yeah, this was at the same meeting that I was attending recently, where the topic was this transition notice, and the question was posed to the Department of Labor and IRS when we could expect to see follow-on guidance that would provide additional rules to assist institutions to understand how they could bring their plans into compliance. Mm-hmm. And there was, just a pregnant pause. And ultimately, IRS and the Department of Labor said that they are not working on guidance and that there was not any expectation that additional guidance would be provided. Now, let me now pause and say that that does not mean that we won't see additional guidance. I know, Stephen, you will be working with some of the groups that are on the phone. Heather, I know you are in touch with other, institutions who are concerned about how to bring plans into compliance. What it does mean is that some institutions, and several of the people who were at the meeting that I was attending came up to me afterwards and said that they understood the notice to mean that there would, in fact, be additional guidance. And I think some of that was because the guidance leaves open to how you come into compliance. I know the next section we're going to be talking about here is how can an institution bring their plans into compliance with the existing ACA rules. I think the reason that notice is more open-ended is because the agencies are aware that colleges and institutions have many different arrangements for subsidizing the healthcare coverage for their students, as we talked about earlier. And so the only takeaway I would say here is that for right now, and they said this at the meeting, that we've provided you with transition relief. We've provided you with the relief through the academic year beginning in the fall of this year, so through 2017, and that's a period of time that we will not be enforcing the rules, but it is also a time to consider how you're going to bring your plans into compliance.
I would just add to that the guidance that was issued, I think, in part because we knew that the regulators were concerned about these subsidies, and we asked them for guidance. When they issued the guidance in February, I was told that they definitely wanted to continue having conversations with ACE and others who were interested in this issue, and it was suggested to me that there was the potential that there would be some additional clarification. And if you read the guidance, and obviously in addition to these slides, which will be available, this whole webinar will be available after the fact, we'll make sure to make available the guidance so you can see that in consort with the webinar. The guidance is fairly vague on what is or isn't really a permissible a way to provide these subsidies. It's a very fact-bound analysis, and we're going to do in a second here, Helen and Heather, and I'll try and help too. We're going to give you some ways in which you can hopefully, based on what we have thus far, implement changes that we think would be permissible. But notwithstanding the fact that the regulators say right now they don't have anything in the works, it is possible that there will be something issued to help clarify what they said in February sometime in the not too distant future. So
yeah, absolutely. It was pressure that got them to issue this guidance. I think one thing that's interesting is they actually thought this guidance would be greeted with a sigh of relief by higher ed institutions, because their assumption was that higher ed institutions already knew and understood this, and that this relief would be welcomed by the community. But in the absence of, now that their position is clear, I think it's incumbent on us to press for additional changes and clarifications, because in the absence of guidance or pending regulatory relief, it is incumbent on institutions to really take a minute to ask themselves some key questions and to understand their current arrangements, whether they have an insured plan or a self-insured plan, what the implications are for this market guidance and for the employer mandate guidance. Institutions are going to have to understand the implications of whether or not they are providing their subsidy on a pre-tax or after-tax basis and to whom they are doing it. And I think what might be most helpful also is to kind of look at the questions that are coming in, is spending the rest of our time together walking through some specific examples about what we see institutions doing and how others are complying, what are, you know, maybe safer approaches that are in line with the guidance, and just maybe walk through some of those choices that we see colleges and universities making. Helen, do you want to maybe start by walking us through some of the more frequent ones?
Yes. So here are some alternatives on this page that I think we know will come into compliance, that will bring a plan into compliance. And as I go through this, I will try to address some of the questions that have come in. You know, one question, you know, that was asked at the start, well, isn't it permissible just to subsidize an individual policy? And that's the exact issue. Is, you know, unfortunately, that's the problem. That's where you know, the guidance has said that that subsidy, that reimbursement payment, is in fact not in compliance with the ACA rules. So what can you do to come into compliance? Well, the first thing that an institution can do is to cause the student subsidized coverage to be integrated with a group health plan. When I went through the guidance and talked about the arrangements that were permissible, the one that is definitely permissible is a subsidy or a payment reimbursement of coverage that is actually sponsored by the employer and is treated as a group health plan. But what does this mean for you as an institution? And I should mention that I am aware of several, you know, large institutions that have taken this approach, maybe begrudgingly, but they have moved forward to say, okay, fine, we do have graduate students that are providing services to us. We are going to treat them as employees, and we are going to subsidize coverage that our own university offers. So it is the employee or the employer-sponsored employee health plan, not the student health plan, but the employer-sponsored health plan. The graduate students would become covered by that program. So that has implications. That could be more costly, both for the student as well as the institution. It can also raise a question for the graduate students. I know in a conversation that we had, Stephen, that I think you had arranged for us with an institution that was, you know, very helpful. You know, they walked through how they've designed their student health plans to meet student needs, and it was, you know, I think it's a real eye-opener that, you know, students have different issues than, you know, others, and the coverage that is offered to employees of an institution may not have the same type of coverage. So although this is a solution that works, it doesn't have, you know, the same, you know, benefits as being covered under a student health plan. And then finally, there's also the issue that what do you do with an employee, you know, a student that go, you know, is providing services one semester but not another semester, and they go in and out. So what's another solution that definitely does work but has its own considerations to be taken into account? That would be if subsidies were provided across the board to all graduate students, regardless of whether they're providing services or not. The reason that that works is that it means that that subsidy is being provided to the graduate student in their capacity as a student, not in connection with services being provided. As I mentioned, we know of some institutions that do just that, you know, that would be permissible. But then there are other institutions that, for cost reasons and others, have said that, no, we will subsidize the coverage as long as you are providing us, you know, with research services, you know, teaching services or other services are being provided. So that does raise some other both costs and tax considerations if you decided to move in the direction of offering across the board to all grad students. Why don't we move to the next possibility. Now this arrangement, I think, is one that causes some administrative complexity and also would require, I think it would be important to get administrative guidance. I think you could probably get that guidance, but I don't know if it's something you would necessarily feel comfortable applying this alternative without the immediate guidance.
Helen, there have been a couple of questions that have sort of raised, and Heather mentioned this other student category, although this call is really focused primarily on graduate students. Before we get to the next possible alternative that Helen's going to describe for you all, there have been some questions about, does this affect other students, like undergraduates? So we know that if an institution requires all students to have health insurance, whether they get it from the institution, whether they buy a student health insurance plan from the institution or they have it from their family or from some other source, under the Higher Education Act, many institutions are allowed then to subsidize the cost of a student health insurance plan in their financial aid award for an undergraduate. And the question is, how does all of what we've been talking about today, does that have some impact on undergraduates? And I would put that to our experts to give a quick response to that question.
Quick response. All right, I'm going to give you a response. It's a typical lawyer's response and say it really depends on the facts. The way you set those facts up, though, where it's, there are these undergraduate students, there is a requirement. I know from having nieces and nephews who are in college, and they are all required to have health care coverage either through their parents' plans or through the colleges, universities that they attend. In that case, even if there's a financial aid package, as long as it's being provided, again, that coverage is being provided not in connection with the services that they're providing to the institution, I do not think that that would raise a question. Now, if they designed the plan differently or if the arrangement were different and the student only received a subsidy and received it directly, maybe separate, it was connected to the financial aid package, but was coming directly from the university and was only in connection with the services that were being provided, I think that raises more of an issue. But in the facts as you presented them, Stephen, I think it would be okay.
So generally, if institutions are providing subsidized to undergraduates, it's part of their financial aid package. If there's no connection to what the student and any work they engage in, if it's provided potentially to all students based on need, there's little risk we think that that this problem is going to apply to undergraduates, right?
Yes, and I think the key, Stephen, in what you said, and let's just emphasize that, is that aid is not being provided in connection with the services they're providing to the institution. It's being provided because of need.
Okay, terrific.
All right, so under the next alternative, you would really bifurcate your student health plan. And for those, we'll focus again on graduate students, those graduate students that are providing services and, in the IRS's view, treated as employees. The subsidy would be used to subsidize the student health plan, but that portion of the plan would actually be treated as an employer-sponsored group health plan because of the employee-employer relationship between the student and the university that is subsidizing the coverage. That would work, as I mentioned, again, the subsidy is subsidizing or connected to and integrated with group health coverage, so it would comply with the ACA requirements. But it does raise these other considerations, that means that the university would then have a portion of its student health plan that is treated as a group health plan that would be subject to all the ACA requirements and also subject to other ERISA requirements.
Helen, this one actually is a question that's been raised by one of our listeners, which is, could you please give an example with a self-funded student health plan and some of the implications? So they're feeding right into our next slide here.
Yeah, they're feeding into the next slide. And let me start off by saying that this is a complicated area, and seems like that that child's toy where you push one button down and something else pops up. So every time you sort of solve an issue, you have another issue that is created, and I feel like that's happening with self-funded student health plans. So let's sort of start to walk through what the issues are. First of all, the reason that some universities that do offer self-funded student health plans may feel that they are in compliance by subsidizing the coverage for their grad students connected to that student health plan is because we don't have HHS guidance that says that self-funded student health plan is individual market coverage. So you're not integrating with an individual market policy. However, if the institution is subsidizing the coverage, and if the coverage is being subsidized to a grad student who is the IRS would treat as an employee, in order for that subsidy to be in compliance with the IRS guidance, it needs to be integrated with a group health plan. So I don't think you get out of the compliance woods by just assuming that if it's self-funded alone, that there's no issue. You still would need to consider whether that group health, whether the student is an employee, and if so, the subsidy would need to be integrated with a group health plan. The self-funded plan could, or at least a portion, as we talked about in the prior slide, a portion of the plan could be treated as a group health plan. But again, you have the same implications that it's now a group health plan subject to all the ACA requirements and also ERISA considerations.
And you still have risks with the employer mandate as well. So one of the other questions, Helen, that we have is, can I just provide a gross up to my students? Can I just pay them money
on an after-tax basis? Yeah. So you're assuming that. Remember, I mentioned if you are providing coverage to an employee or a reimbursement to an employee, that can be provided on a pre-tax basis. What if you just said, okay, forget it, we don't want to treat them as an employee, we'd rather just treat this as a after-tax benefit? In some circumstances, that may work. If there's a gross up that's provided by the university, either across the board or even provided to a graduate student who's providing services, as long as that gross up is not tied to the purchase of healthcare coverage, student healthcare coverage or other coverage on the individual market, then I think you have an argument that it works. I mean, there may be an understanding that the gross up or the bonus would be used to buy coverage, but if there's no ties, I think there is an argument that that it would meet the requirements because you're not treating it as a reimbursement directly of individual market coverage.
So let me see if I can spell that one out a little bit more, because I know about at least one institution that's doing that, and this isn't a perfect solution. It's got some problems with it, and we could go through those and talk about that. But just for purposes of this discussion, let's say an institution pluses up or tries to hold harmless the graduate student by giving, let's say, the graduate student an extra $1,500 a year to hopefully go and buy insurance. Now, could the school then say, well, here's our ship coverage, you can buy it, it's X dollars, it's $1,500 a year, or here is individual coverage you can buy on this state, let's say it's New York State's individual market that's roughly equivalent to our ship coverage, here it is, you can go. Now, it's up to you, student, to go and decide how you're going to handle that. Or you could go and buy, if you wanted, a new flat screen television. That's your choice. And that would be permissible, is that right, you think?
Yeah, I mean, back when I was at the government, I would say these are my personal views and not the institutions. I would want to spend some time looking at the facts, but the way you describe them, again, because that bonus, the plus, the additional $1,500 that you talked about is not tied directly to purchasing any particular individual policy or even purchasing health coverage at all, I think you would be fine. That would be treated as taxable compensation in that circumstance, but would not cause the institution to be in violation of the ACA rules because it's not directly a reimbursement of individual healthcare coverage.
Okay. Now, we understand that that isn't a perfect solution. It creates other potential problems because many times the largest number of insureds under student health insurance tend to be graduate students. That's really because in the past we've paid for their coverage. That means that if there were a drop-off on the number of students, grad students who were participating in the SHIP plan, that means there are fewer insureds. It potentially means that there are the SHIP plan itself would be more expensive for all students, graduate students and undergraduates. So it's not a perfect solution, but it is a solution. So, okay.
Yeah, we should mention maybe the, I think someone asked this question where they just don't offer health care coverage at all or don't offer or eliminate the subsidies. Yes, that is a solution. That's an unfortunate solution, and, it sort of flies in the face, I think, of the language that, Heather, you talked about at the beginning of this section about the Affordable Care Act, saying we want to reinforce the importance of student health coverage. But it is something that universities are probably thinking about.
Well, although I would just add there that it may eliminate the risk of the excise tax penalty for the market rules, but you may still have exposure for the employer mandate penalties because the common law definition of an employee that applies for the market rules is the same one that applies for the employer mandate penalties. So if those are indeed your employees, and if some of those employees are working, on average 30 hours per week or more, those individuals may, trigger a different penalty for you. The A penalty, which is the penalty for employers that fail to offer coverage to their full-time employees, is based not just on that one employee, but you have to pay it on your entire full-time employee population. So that could include all of your faculty and other graduate students or student workers who are working on a full-time basis. So
can I interrupt you for 1 second?
Yeah.
I'm trying to not get too far into the weeds, but you're raising a very good point, because this year, and because we didn't go into the details of the employer mandate, I think we should at least mention one important detail, that for 2016, an employer has to offer coverage to all full-time employees, to 95% of all full-time employees. So, I think, Heather, your point is if you decided not to offer this coverage at all to the graduate students, if some number of those graduate students, in fact, do work on average 30 hours or more per week, and if it's 5% or more of the total full-time population, that's where you could have the excise tax that's imposed based on all full-time employees, not just those individuals who go to the exchanges.
Yeah. So we have just a few minutes. We wanted to turn and talk a little bit briefly about some of the legislative and regulatory opportunities for changes. As you can tell, we walked through all of these potential remedies. There are holes and challenges with all of them, and none of them are particularly tidy fits for institutions. So there are some legislative and regulatory opportunities that are coming up, and we'll try to touch on those. And Stephen, maybe I'll turn it over to you for a second, and then we can try to answer a few more questions.
Right, because we see that there are a couple of questions, and we understand this is very complicated. I've been working on this issue now for, 8 or 9 months, and each day, unfortunately, I learn something new, and none of it is very good. So it's a difficult issue, and we'll do our best to get back to some of your questions. And as I said earlier, and we've indicated in response to specific questions, this webinar will be available online on our website, and we also will be distributing very soon, probably at about the same time, a document that Helen and Heather have been working on that analyzes, in a very similar fashion to what we've had today, that analyzes the guidance and provides in writing some of the material and some of the explanation that we've had today that will be available on our website as well. So on the regulatory and legislative side, I would just say this. First of all, this issue, and as I understand, you probably all are thinking that your head wants to explode. One, because it's very complicated, and two, it seems maddening. We are doing what you'd think the government would want us to do under the Affordable Care Act. That is that we're offering our graduate students, and in many cases at no cost, very comprehensive student health insurance. That provides them terrific benefits. It's very tailored to their needs, et cetera, and you think, why would the government want to disturb that? Well, you're right. It's maddening to those of us here sitting around here doing this webinar. And I think part of the challenge is that it's the career regulators who are looking at what their statutory authority is under the ACA and saying, based on that, and as well as the common law definition of employment that was discussed earlier, under those circumstances, that's why they don't think the practice, the longstanding practice, is permissible. So we are looking to try and get the regulators to change their mind. One of the things that we found out yesterday, and we've been working to try this to get this to happen, is that Senator Schumer of New York is leading an effort to get a number of senators, and we're really focused on Senate Democrats, not for any partisan reason, but we felt like that the administration would be more responsive to hear from Democrats. That there is a letter that Senator Schumer's office has finished and is now circulating for signature. It will go to the Secretaries of Treasury, the Department of Labor, and Health and Human Services, really pushing back on the guidance that was issued in February and asking the regulators, the administrative agencies, to basically change their mind and to issue final guidance that would allow us to provide these subsidies in a fashion similar to what we've always done. And so if this is an issue on your campus, what would be really helpful to me is, and if you have, in particular, if you have federal relations people, go to your federal relations person and say, yeah, this is a problem for us, and ask them to get in touch with me. You can find my contact information on the ACE website. My email is sbloom@acenet.edu. So just tell them to get in touch with me, and I will work with them and partner with them in trying to get senators signed on to this letter, as many as we possibly can. So, but on the legislative side, I think it's fair to say, and Heather's nodding her head, that there's not much, unfortunately, happening in Washington legislatively, and that's even less true on Affordable Care Act potential changes, because you wouldn't be surprised to hear that the Affordable Care Act, the politics around it are still very toxic, and so it's very difficult to get the two sides to come together in a way that, even on issues like this, where I think that both folks from both sides of the aisle would say this isn't really what we would want to see happen. It's going to harm graduate students and potentially harm institutions, and so we could probably find a bipartisan solution, but the ability to do that, because very little is happening on the Hill now legislatively, so it's not likely that there's going to be any legislative fix to this, at least until, for the remainder of this year. With a new president and a new Congress, it's possible, but it certainly isn't going to happen in 2016. Do you think that's right, Heather?
And it's not going to happen fast enough for institutions to make the kind of plan design changes and decisions that they need. So it's, it's important to be working on all fronts.
So we are working to get the guidance overruled, in a sense, by people further up the food chain and the administration and the executive branch agencies, and hopefully with your help that may be possible. So why don't we turn back to some of the questions that we have in the few remaining minutes. There's a question about, and it comes back to this, the complexity of this. One of these questions is, well, if our grad students work under 30 hours, can they still have ships subsidized? And that goes back to the basic question, the complexity of it, that Helen, maybe you can sort of clarify and answer that question.
This is, I think there's a misconception here that the only reason why the subsidy may not comply with the Affordable Care Act provisions is if a student works on average 30 hours or more. That's not correct, unfortunately. I wish I could tell you it is, because I'm sure a lot of graduate students don't work that many hours on average per week, but the real nub of the issue is whether the graduate student or other student, but we're focused on graduate students here, whether they are providing services in such a manner that the IRS would treat them as an employee. and they may be a very part-time employee. They may be working only 10 hours a week, but if they are treated as an employee, that's when you run into issues with the subsidized coverage, particularly if they're subsidizing the coverage that's connected to a student health plan or another individual market health plan. The 30 hours on average per week rule is the rule that applies exclusively for purposes of the employer mandate. That's the only time when an employer really counts those individuals for purposes of the employer mandate. But for the purposes of this other guidance saying that, the reimbursement itself has to comply with the ACA, if you're a student for any, or if you're a student who is treated as an employee for any number of hours, on average per week, you still run into the issue.
But it really requires graduate students to engage in certain activity, like if they're engaged in teaching, or they're engaged in research, or maybe they're engaged in some administrative duties. That's really what, in your view, or you think that the regulators, that's where the IRS,
that's the only.
They look at that under the common law definition of employment. They say, oh, because of that activity, that is an employee under the common law definition of employment, and as a result, we believe you cannot offer them subsidized student health insurance coverage, which has been defined as a form of individual coverage. The second question.
So you can't provide the subsidized coverage if it's subsidizing individual coverage.
Correct, right. Then there's the second question, or do they work 30 hours or more? And that's where the question comes in of, oh, do we have to offer them employer-provided insurance? That's only, that's where that comes in. But the, sort of the threshold question is, are they engaging in some kind of activity where the IRS is going to say, oh, because they're engaging in activity and you control it, and under the common law definition, they are employees. And so that's what precludes you from giving them subsidized student health insurance, right?
Yes, that's a good summary. It's you first look to the activity. Does that lead to, a treatment as an employee? And then you have to analyze your arrangement.
Right. So to come back a little bit, and there was a question, and we're not going to spend too much more time because we're a little after 2 o'clock, and we promised this would only be an hour. But and Helen and Heather, you had talked about it earlier as one solution, which is to basically say we're not going to think about the activity of what the graduate students are engaged in on campus. We're going to give this subsidy to everybody. And regardless of whether they're engaging in some kind of activity that would be seen as employment, right? And that would be permissible, right? You could do that, right? It's expensive, potentially. Some institutions may already be doing that, but that would be one way that they could comply with the Affordable Care Act. If they're giving it to all graduate students, regardless of whether they're engaging in activity that the regulators see as a form of employment, right?
Yes. Well, 2 comments on that, just to clarify the point. That type of subsidy is permissible because it's not tied to your role as an employee, not tied to the activities that make you an employee. However, I don't want to leave the thought, without going back to the comment that Heather made earlier, that if they still are engaging in those activities and they're treated as an employee, if their activities or work during the week rises to the level of 30 hours or more per week, then you run into the question about the employer mandate. Right. So there's these 2 pieces of guidance. There's the guidance that specifically focuses on the subsidy that's tied to the activities of the student, whether they're treated as an employee. And then once you get over that, then you have to look at whether or not you're offering coverage that's employer-sponsored coverage to satisfy the employer mandate. So the basic answer to your question, though, if you're just focusing on the subsidy and you apply the subsidy across the board without regard to the services that are being provided, that does work because it's not tied to their role as an employee.
Okay. Let me, this is sort of a technical question, but that was asked a couple of times. The taxation, this question of taxation and whether this is you're providing this as a taxable benefit if you're giving this subsidy. Maybe you can explain this pre-tax, post-tax issue a little bit so that people understand that.
Well, I'll try to explain it quickly, and then I'm going to have to conclude this by saying, once again, it's facts and circumstances. There is a tried and true rule in the Internal Revenue Code that says that if an employer is subsidizing coverage for its employee, that subsidy is not taxed. It can be provided on a pre-tax basis. Now, we do know, and Heather and I had a conversation with several institutions that, in fact, treat the subsidy as a taxable benefit. There are a number of different reasons why they may treat that subsidy as a taxable benefit. One of them may be is that the institution says, no, we don't treat our graduate students as employees. They are students. That's their status. That's where they start as a student, they end as a student. Even if they're providing services, we don't treat them as an employee. And consequently, unless there's some other exception in the Internal Revenue Code for excluding the subsidy as a taxable benefit, it would be treated as taxable income.
Okay. So it's now 2:10. There are a number of questions that have come up. Some of them we aren't really we hadn't planned to answer on this call. On this webinar. I'm trying to think. Maybe you could, and then this would be our last question, and then we'll wrap it up. There's a question about this idea of sort of bifurcating in the SHIP plan, and you talked about that as one possible alternative. Helen, maybe you could explain that one a little bit more, or explain it again so that people understand that as a possible alternative.
So maybe I'll just make one comment, and then Heather, I'll turn it over to you, because I think in that question, the questioner appropriately asked, whether it's possible to explore administrative guidance. The reason that I think we thought that it may be a possibility of bringing a plan into compliance is that if, again, the graduate student is treated as an employee and the subsidy is used to purchase or to pay for the student health coverage, which right now is treated as individual coverage, that in that case, that graduate student / employee has an employment relationship, and consequently a portion of the plan, it may be the same coverage, maybe the same network. I know there's some other complexities around that, but at least it is a concept that may permit the graduate students to continue to have the type of student health coverage that has been designed for students. And so Heather, you probably have some thoughts on how you would approach this.
I think that there are two things administratively there. One is, just consider keeping in mind that portion of the health plan would also have to comply with all of the other ERISA and group health plan rules. And I think this is a good framework as we think about next steps and moving forward and how the regulators are thinking about student health coverage and universities generally. We know that everyone on this call today is very, very special and unique. IRS and DOL don't necessarily think so, because they have been working through with a lot of employers, a lot of these different challenges and a lot of different employment arrangements. I think they are very interested in approaches that are approaches where they feel like they have the authority to help institutions work within the existing group health plan, individual market, ACA framework to come up with solutions. So a solution where they're not creating new rules about who is or who isn't an employee are solutions that they may be more willing to explore. So if it's, helping us define a particular piece of a student health plan as compliant with ACA regulations, if that plan is meeting all of the other group health plan requirements, and we are really working to stay within the spirit of the ACA, and at the same time finding a solution for these graduate students to receive this ideal coverage for them, those might be areas where they're more willing to continue to engage with us as we look for solutions that are a better fit for institutions. So I do think there is a lot that can be done here. I also think that it is going to take some political pressure from institutions to engage on this issue, both on Capitol Hill and with the regulators.
Thank you very much, Heather and Helen. I know this is very complicated. There are lots of questions that we may not have specifically answered. We tried our best. You'll see in the slide deck, which will be available, the slide deck as well as the webinar will be available on our website. Also, as I mentioned earlier, we will have a document that goes through much of what we talked about, what our experts from Ernst & Young talked about today, about sort of students as seen as employees, and the guidance, the specific sort of language in the guidance and what it means, and potential ways that you might be able to respond to that. And I'll make sure that the February guidance is included in our website in an area on the website that's very close to the webinar link and all the other materials. So hopefully we were able to answer many of your questions. I do see that there are some that we may not have gotten to. If you can email me your question if you want. I know on the deck it also has the email for both Helen and Heather. They may regret that, but it is there, and you may take advantage of that to a limited degree. In any event, here we are after 2:15. We want to thank all of you for participating in today's webinar. We want to thank all of our co-sponsor associations that are listed on our website, and most of all, we want to thank Helen and Heather for bringing their expertise to this webinar today. It was very valuable. So thank you very much, and I hope you have a